So there is this investment out there that the government will literally pay you to buy. You put your money in and you get a tax credit just for showing up. And if you set it up right, you can stack that credit on top of your RRSP deduction and basically get money back twice on the same dollars. When I first heard about that, I thought, okay, what is the catch? Because there is always a catch. And there is. These things are called labor-sponsored venture capital funds, and there is a very real reason your advisor might not be pushing them at you. So today, let's walk through the whole picture together, what they actually are, how much you really get back, the risks nobody puts in the brochure, and honestly, whether they are a smart move or a hard pass for someone in your shoes. Let's start with what these actually are. A labor-sponsored venture capital fund, or LSVCC, is basically a big pooled fund that takes investors' money and puts it into small, private, up-and-coming Canadian businesses, the kind of companies that are too small and too risky for a regular mutual fund to touch. The government wants money flowing into those businesses because that is where a lot of Canadian jobs and growth come from. So it dangles a reward. Back these smaller companies through one of these funds, and you get a tax credit for doing it. That is the whole deal in a nutshell. You take on more risk, and the government says thanks by knocking money off your tax bill. So what do you actually get? Really, three things, and I want to go through them honestly, the good and the not so good. The first thing is the headline, the tax credit itself. On the federal side, you get a 15% credit on what you put in, up to a set yearly limit. So put in the maximum, and that is a few $100s handed straight back to you at tax time. And here is where it gets more interesting. Depending on your province, you might get a provincial credit stacked on top of that federal one. In some provinces, there is nothing extra. In others, especially in Quebec, with funds like the FTQ and Fund Action, the combined credit can be really substantial. So the first thing to know is that where you live changes this deal dramatically. Same fund, very different reward depending on your province. The second thing is the clever part, and this is where Canadians can really stack the benefits. You are often allowed to hold one of these funds inside your RRSP, and when you do that, you get the RRSP deduction as well as the tax credit. Think about what that means. Your RRSP contribution lowers your taxable income, which is worth more the higher your tax bracket. And then the fund's tax credit comes on top of that, so a higher earner in a generous province holding one of these in an RRSP could genuinely get a big chunk of their investment back between the credit and the deduction. That double up is the single most attractive thing about these funds, and it is why they mostly appeal to higher income Canadians who already have RRSP room to use. And now the third thing, and I have to be straight with you here, because this is where a lot of online hype goes quiet. There is no safety net. Some countries have programs where the government covers a chunk of your losses. That is not what this is. There is zero capital protection. If those small private companies struggle, and plenty of them do, your money goes down with them. These are genuinely high-risk investments. So please keep that front of mind while we talk about the rest. Let me put some rough numbers on that double up so you can actually picture it. Say you put $5,000 into one of these funds held inside your RRSP, and you are a higher earner in a province that offers its own credit. You might get a 15% federal credit, plus a provincial credit, plus an RRSP deduction worth your marginal tax rate. Add those up, and you could get well over half your money back at tax time, at least on paper. That sounds unbelievable, and in a generous province, it can be real. But, and this is a huge but, in a province with no provincial credit, and for someone in a lower tax bracket, that same $5,000 gives you a lot less back. So just like most of these programs, the richer the taxpayer and the more generous the province, the better this looks. For a lot of Canadians, it looks a lot more modest. Now let's talk about the catches, because there are a few big ones. First, your money's locked up. To keep those tax credits, you generally have to hold the fund for 8 years. 8. Cash out early and the government wants its credits back. So this is money you are parking for the better part of a decade, not next year's emergency fund. Second, the fees. These funds are famous for high management fees, often much higher than a simple index fund, and those fees quietly eat away at your returns every single year. Third, and this is the big one, the track record. Historically, a lot of these labor-sponsored funds have delivered pretty underwhelming long-term returns. And here's the trap. If the fund barely grows or loses money over those 8 years, that shiny tax credit you got up front can end up being wiped out by weak performance and high fees. The tax break is real, but it is not a free lunch. Never let a tax credit talk you into a bad investment. So who is this actually for? Let me give you my honest take, starting with who it might suit. First, higher income Canadians, especially those who have already maxed out their TFSA and their RRSP room and are looking for another tax-advantaged option. Second, and this is important, people who live in a province with a generous provincial credit because that is where the math actually gets exciting. Third, folks who genuinely understand the risk, are okay locking money away for 8 years, and like the idea of backing small Canadian companies. If that is you, a small position might make sense. Now, who should probably take a pass? First, beginners and lower income earners. If your tax bill is small, the credit does less for you, and honestly, you should not be taking this kind of risk with money you cannot afford to lose. Second, and I cannot say this loudly enough, anyone who has not yet maxed out their TFSA and RRSP. Those come first every single time. A TFSA grows completely tax-free, and your RRSP already gives you a deduction without the 8-year lock and the high fees and the shaky track record. Do the simple, powerful stuff first. Third, anyone who might need that money within 8 years. And fourth, anyone in a province with no provincial credit, because without that top-up, the reward often just is not worth the risk. So let me bring it all together. Labor-sponsored funds are a real tax break. A federal credit, sometimes a big provincial credit, and the ability to stack it with your RRSP deduction. But they are high risk, they carry high fees, they lock your money up for 8 years, and historically a lot of them have not performed well. For most people watching this, the game plan is simple. Max out your TFSA, then your RRSP, and only then, if you are a higher earner in a generous province with money to spare and an appetite for risk, take a careful look at these as a small extra. Not before, and because the rules here change all the time and swing wildly by province, please double-check exactly what is offered where you live before you commit $1. Okay, real talk to wrap up. If a tax credit ever tempts you into an investment you do not fully understand, that is your signal to slow down and do the boring stuff first. Give this a like if it saved you from a shiny distraction, subscribe if you want more of the honest breakdowns, and go check how much TFSA and RRSP room you have got sitting there unused, because that is almost always the better move. Thanks for hanging out, everybody.